Hi everyone, and welcome back to the ET Money channel. There's a lot of speculation in the news that premiums for new term insurance policies are going to increase from as early as April of this year. So we made a few calls, met a few insurers, and gathered a whole bunch of information to see if we can make sense of what is exactly going on. If you are new here, don't forget to subscribe to the ET Money channel, hit the bell icon, and access our growing repository of videos on topics like mutual funds, SIPs, insurance, NPS, and basically anything that can help you grow your money or help you save some money. Let's get started. A good place to start our analysis is to get an understanding of how term insurance policies are priced. A word of caution here. Some terms used in this video are industry definitions and might be new to you. I will do my best to add an explanation of most terms in the description below. In case something gets missed out or you'd want more information, do write back to me in the comments box and I'll be happy to address that point for you. Right, let's start with some basics. A term insurance policy is a very long-term contract running into 30, 40 or even 50 years. This means the insurance company or the reinsurance company takes a fairly high amount of risk as assumptions might change from time to time. These assumptions are what we call as the four pricing elements that can be used in arriving at your term insurance premium. These are: number one, the cost of mortality. The mortality cost is that part of the premium that is charged on the probability that the policyholder will die at a particular age. This cost is the most important component in determining term insurance premiums with a 50 to 70% weightage. Number two, the insurance company's operating expenses. Operating expenses include all costs related to servicing a policy, disbursing a claim, marketing and distribution expenses. The third pricing component is the persistency or the lapse rate. The lapse rate is an assumption. This is where the insurer is guesstimating how likely is it that a policyholder will stop paying premiums in the future. Crudely put, young term insurance buyers lapsing their policy is bad for business. But older term insurance policyholders lapsing is actually good for the insurer's business. And finally, the fourth and the last element that goes into pricing calculations is the investment income. Investment income are the returns earned by the insurer on the premiums advanced by policyholders. Currently, insurers make about 8 to 9% per annum, but this might not be the case 10 or 20 years from now as interest rates and bond yields tend to swing over the years. To quickly recap, the four pricing variables in determining the term insurance premium are the mortality cost, the insurer's operating expenses, the lapse rate, and the investment income. You must have figured by now that all these four pricing variables are assumptions running into decades. It is now the actuary's job to convert these multi-year estimations into a fixed annual premium that can be charged from the policyholder throughout the entire term of the policy. In this section, we look deeper at the pricing components and understand why the need for premium increase has come up. We discussed earlier that the mortality cost is the biggest expense component in determining the term insurance premium. The reinsurer estimates the mortality cost by referring to a table called the Indian Assured Life's Mortality or IALM table that is published by the IRDA. This table gives the mortality rates or the rate of deaths occurring across different age groups. For example, the mortality rate for a 30-year-old male is 0.000977. This means for every 1 lakh 30-year-old males in India, 97.7 males are expected to die in a single year. The same number jumps up to 443 per lakh for a 50-year-old and just over 2,400 deaths per lakh for a 70-year-old. In addition to consulting the IALM table, additional conditions are imposed in acquiring term insurance policies to control the claims experience. These include the customer profile in terms of income and education, cities from where policies can be sourced, acquisition channels like banks, agents, online, etc. This is where some calls taken by the insurers and the reinsurers did not fructify in the manner that it was predicted, which has led to an adverse claims experience. In other words, the number of deaths were more than the assumed numbers. In addition to claims experience, our research reveals that some process accommodations offered by industry players also did not pan out as expected. For example, there is a practice of offering waivers on medical tests for select sum assured for some age groups or income brackets. Generally, I see that a few popular insurers waive off medical tests of up to 1 crore of sum assured if you are less than 45 years of age and if you are a graduate. It is very likely that these calls too have not gone as expected, and the insurers will have to relook at these controls. Net, our assessment is that the potential premium increase in term insurance plans is a mix of the mortality assumptions not panning out as expected and the underwriting controls being overly relaxed. In this final section, we look at what to expect from the life insurance companies in the near future. Let's understand this by drawing up a classical P&L statement. Currently, for every 100 rupees of premium collected, the cost of mortality is 60 rupees, expenses are 30 rupees, and therefore the insurer makes a profit of 10 rupees. Now let's say the mortality cost increases by 20%. Therefore, the new mortality cost will be 72 now. We now look at a few scenarios that the insurers can adopt. Scenario 1. Pass the entire increase in mortality cost to the customer by increasing premiums proportionately. While this is easy to do, a move like this will keep the sales team quite jittery, as it might lead to a drop in the take-up rate of term insurance plans. Having said this, the insurers can also decide to partially increase the premium and compensate the additional mortality cost by foregoing some parts of their profits. Scenario number 2. Keep premiums at more or less the same level with tighter expense management. Expenses have two components: 1. Operational expenses, and 2. Distributor commissions. A reduction in commissions paid to distributors will require renegotiating contracts with distributors, which might have an impact on the product portfolio mix of insurers. And finally, scenario number 3. The insurer can adopt tighter controls aimed at receiving better rates from reinsurers. A better input rate from the reinsurers might be available if the eligibility and underwriting criteria were tightened. For example, insurers might look at pushing the minimum income criteria from say 3 lakh rupees per annum to 5 lakh rupees per annum. This helps because the data obtained from some insurers show that the claims experience in higher income groups is better than the lower income groups. Similarly, tight controls can include having a slightly higher minimum educational qualification, such as graduation instead of an undergraduate or a diploma certificate. In totality, we see that there are a few scenarios that are available for insurers to work on, and the next 2 to 3 months will see the insurers work out many permutations and combinations to get the best fit. Going forward, I expect the insurers to become more prudent in customer profiling and the insurance industry investing in data structures and technologies to have a better assessment of the risk. To sum up, term insurance in India has one of the most competitive pricing from anywhere around the world. And this current repricing should not come as a surprise to anyone, as the fledgling Indian term insurance industry is still in a discovery phase. We can expect many more such pricing and process changes in the future as the industry matures. I hope you liked our research and video content as much as I enjoyed bringing it to you. If you have not opted for a term insurance plan yet or are sitting by the fence, I suggest you watch our previous videos on the benefits of term insurance and how to choose a term insurance plan. I'll add a link of these videos in the description below. Do hit the like button and share this video with your friends and family, and don't forget to check out the term insurance section on the ET Money app for more information of everything we have discussed in this video.